Welcome to The Explainer. Today, we're jumping right into the super fast, high stakes world of Nasdaq futures trading. We're going to decode that constant tug of war between human traders and their gut feelings and the lightning fast algorithms that are pretty much running the show. And we'll do it by looking at one single incredible trade.
So where does our story start? Well, like a lot of them do nowadays, it starts on Reddit. Some retail trader posts about this massive winning trade they pulled off, bagging 110 points on the Nasdaq. Now, that is a huge move. And yeah, the money is impressive, but that's not the interesting part. The real story is how they did it. Because this trade, it was not a lucky guess. Not even close. It was practically a masterclass in reading what the market was trying to do. And it pulls back the curtain on the exact same principles that both regular human traders and, get this, the most sophisticated trading algorithms use to get an edge. All right, so let's put this trade right under the microscope. We're going to break down exactly how it was done and, more importantly, figure out what we can all learn from it. You know, the logic behind it was actually beautiful in its simplicity. It was just a clear three-step process. First up, the trader saw a bunch of aggressive buyers trying to shove the market higher and just completely fail. Step two, they noticed a huge seller step in and just soak up all that buying like a sponge. So what they do? They sided with the big guy. And third, they picked a totally logical target based on a key price level from the day before. Simple. So the real secret here, the big takeaway, is that this wasn't about trying to predict the future with the crystal ball. Nope, it was all about observing what was happening right now. This trader was reacting to the real-time flow of buy and sell orders, a skill we call reading the tape. They were basically just watching the fight unfold and placing their bet on who was obviously winning. And that brings us right to this core concept, order flow. Just think of it like getting a peek under the hood of the market's engine. Instead of just seeing a price chart wiggle up and down, you get to see the actual force, the real buy and sell orders that's making it move. It literally lets you see who's in control, moment to moment. Okay, so seeing someone else do it is one thing, but how do you actually take these ideas and forge them into a solid strategy that you can use over and over again? Let's open up the modern trader's playbook. A really solid Nasdaq strategy isn't about some single magic indicator. It's about combining these 5 key pieces. You got to know the overall trend. You have to pinpoint those key price levels where the action happens. Then you need to confirm your idea with that real-time order flow, manage your risk like your life depends on it, and of course, focus on the times of day when the market is actually moving. Now, one of the most powerful tools in this whole playbook is something called the VWAP. That stands for Volume-Weighted Average Price. This isn't just your typical average line on a chart. It's weighted by volume, which means it tells you the price where the most business has actually been done. The big institutions, the big money, they use this all the time, which makes it a huge magnet for price. And this just lays out perfectly how it all comes together. So a trader figures out the context. Let's say price is above the VWAP, so things are looking bullish. Then they wait for price to come to a key location, like maybe the low from the day before. And then, only then, do they look for confirmation from the order flow, like seeing buyers step in and absorb a bunch of selling. You see? Context, location, confirmation. That's the whole setup. All right, let's keep building on this, because just having a setup that makes money, that's really only half the battle. The pros, the big institutions, they are completely obsessed with something else, something way more important. Is it just about having a giant pile of profit at the end of the year? Absolutely not. The real answer is a lot smarter than that. It's not just about what you make, it's all about how you make it. And that gets us into the world of institutional finance. They are laser-focused on what's called risk-adjusted performance. See, the goal isn't just to make the most money possible, no matter what. The real goal is to get the best possible return for a specific, controlled amount of risk you're taking. It's all about being efficient and building something that lasts. And hey, don't just take my word for it. This research from the University of Essex makes it crystal clear. This isn't just some academic theory. The people actually managing billions of dollars, this is what they live and die by. And now the regulators are demanding it too. This intense focus on risk is what separates a long, sustainable trading career from a short, spectacular flameout. Okay, and this is where our whole story takes a really cool, futuristic turn. Because all of these principles we've been talking about, reading order flow, managing risk, sticking to the rules, they're now being automated at a speed and scale that is just mind-boggling. I mean, think about it. The exact same logic that our trader on Reddit used, spot the absorption, confirm the direction, and hit the button. That's the same logic being hard-coded into high-frequency trading algorithms. The only difference? The algos can chew through 1,000,000 times more data and react in a literal microsecond. So here's a look at how these things are basically built. It all starts with this fire hose of raw market data. That data gets cleaned up and fed into a model that starts spitting out signals. Then those signals go to the main trading algorithm, which holds all the rules: when to buy, when to sell, and when to just sit on your hands. It's a fully automated decision-making factory running 24/7. But let's be real, the market isn't a simple if this, then that kind of place. It's messy, it's noisy, it's uncertain. And that's why the really advanced algorithms use concepts like fuzzy logic. Instead of having rigid black and white rules, it lets the system think in shades of gray. It can weigh a bunch of different factors and adapt on the fly when things aren't perfectly clear. It's basically how you teach a machine to handle nuance. So, you've got human traders carefully watching the market, and you've got these algorithms doing the exact same thing, but at the speed of light. In this crazy competitive world, what does that all mean for you, the individual, trying to find your own edge? Well, the reality is both sides have some seriously powerful advantages. Humans, we have intuition. We have this deep understanding of the bigger picture, the context of why things are happening. And we can adapt to brand new situations we've never seen before. But the algorithms, well, they have untouchable speed. They can process insane amounts of data, and they have maybe the biggest advantage of all. They are completely 100% emotionless. So here's the bottom line. The real battle here isn't actually human versus machine. It's discipline versus chaos. It doesn't matter if you're a retail trader working off a laptop or a massive firm with a whole data center. The path to having a real shot is exactly the same. You need a disciplined, rules-based approach that's built on the timeless principles of how markets actually work. And that kind of leaves us with the ultimate question for any trader today, right? In a market that's dominated by algorithms and swimming in data, what's going to be your biggest advantage? Is it just having more data than the next person? Or is it having the unshakable discipline to follow your plan day in and day out, no matter what? The real answer is probably somewhere in the middle.